seeing super mixed trade this Thursday afternoon. So for Modern Wall Street, I'm Olivia Bono-Voznenko, and I have Stephen Guilfoyle here to tell us what's going on today. Stephen, how you doing?
How are you? Super mixed trade?
Super mixed. I think so. The stocks, we don't really know what's going on with the action today. But were you surprised at the Bank of England's decision to cut rates to a record low?
Not surprised. I mean, Mark Carney was a very thoughtful, very deliberate central banker as far as central bankers go. Had telegraphed these moves. It was on the aggressive side. It certainly didn't disappoint like the Bank of Japan last week. So he cut the interest rate, the key interest rate, I should say, their Fed funds rate. He cut it down to 0.25% from 0.5%. He jacked on some quantitative easing, not just for the government bonds, but for the corporate sector as well. But just a little bit, not too much to get too many people fired up. He left enough room so he can go further in that direction later if he has to. The yen is moving the right way. British bonds are moving the right way. The FTSE was up 1.5% after the move when it was kind of flat beforehand. So he's getting at least an immediate effect that he probably desired after seeing those weak PMIs earlier this week and last.
Now, across the pond here, jobless claims has been a pretty low number, but are we starting to see an upward trend in this department?
Well, jobless claims are kind of stuck where they're stuck. I mean, it's a slight upward trend, but we've been below 300,000 now for a year and a half or something like that. Because this is such a part-time labor force, so many people are working less than 30 hours a week because the corporations are trying to avoid paying for their Obamacare, that in order to, when firms need to reduce overhead, when a firm has saying, let's have a slow season, they'll just cut hours. So you'll have guys working 5, 10, 15 hours a week instead of 25 or 30 hours a week instead of being laid off. So this is now an artificial indicator. It's no longer something traders can go off of when they try to predict how the job picture is.
What should we be going off of?
Well, I like the ADP lately. It's been consistent for about a 6 or 7 month run now. It's been averaging about 180,000 or so, which is pretty close to what each monthly print has been, unlike the government's BLS number, the BLS non-farm payroll number every Jobs Friday, which might average about the same, very close to the same actually, but they're going to throw an 11,000 at you, they're going to throw a 287,000 at you. Basically, they're a government agency, so they're less efficient than a corporation such as ADP. So I'm starting to trust the ADP number more, although I know the trading public watches the BLS number, so you do have to pay attention there.
Oh, well, good to know. Now, how has earnings season been so far?
Better than expected. It's still lousy, but it's better than expected. Energy earnings have still managed to drag down the overall picture, but we were looking at earnings of maybe a reduction of 5.3% year over year from last for this quarter. It's going to end up being something like 3.7, 3.8%. And that may still improve because we still have the retailers next week and the week after. And of that weak GDP number that we saw last week, the strength was in personal consumption expenditures. And we've seen 3 straight months of core retail sales that were better than they have been in order to support that. So there is a chance you're going to see better numbers than you might otherwise think from some of the core retailers.
Oh, nice. Yeah, next week's earnings, that's my favorite department. Shopping, clothes, food. Any other highlights we should be paying attention to?
It's going to get a little bit quiet here in the middle of August, but as we get towards the late part of August, we're going to start talking about the BOJ again and the Fed again. After this BoE move this morning, the Fed funds futures, which was pricing in a 23% move in September just yesterday, is now only pricing at about an 18% chance of a move. So Mark Carney's step towards the Keynesian abyss has allowed the Fed watchers to breathe easier a little bit about a potential hike.
All right. Well, thank you so much, Stephen, for making it clear of these super mixed markets. That's a joke. Yep, super mixed. Anyway, we'll have a lot to talk about next week. Thanks for joining us today.
Anytime, my friend.